This will blow your mind if you've been waiting for the perfect time to invest. We just survived what many are calling the crash of 2025, and guess what? Now is when real investors get rich. Not in bull runs, but in the moments like this. Stocks are finally back to same valuations, and I've got 5 picks that I believe will crash the market over the next 5 to 10 years. One of them is quietly down 20%, and I believe it's one of the highest quality businesses in the world. Let me show you what I mean. Hi, I'm Matthew, your fellow investor, and welcome to another investing video. Today, I'm breaking down 5 long-term stocks I'm planning to buy for a fundamentally compounded portfolio. Some of them are already in my portfolio, and the last one, my absolute favorite. Let's dive in. Quick note before the stocks, just so you know how I pick this. For profitable companies, I use a DCF model, which is a discounted cash flow model. It estimates future cash flow and discounts it to present value, helping me figure out intrinsic value. If the company isn't profitable yet, I look at price to sales ratio, estimate margins, and projected earnings. All data comes straight from investor relations pages, and prices are up to date as of today's trading. Number 5 is Netflix, ticker symbol NFLX. I don't hold this one yet, but I'm watching it closely. Netflix is up over 30% year to date, outperforming the broader market by a lot. Yeah, it has a high PE ratio, over 50, which might scare people off, but here is the thing. Investors are pricing in growth for a reason. Cash flow is steady, even slightly up from last quarter. Management has straight up said they want to double Netflix value within 5 years. If that holds, we are talking about 100% upside. Personally, I'll be buying on the dips. And I wouldn't be surprised if Netflix beats the S&P 500 easily in the coming years. Do you think Netflix can really double from here? Or is it priced for perfection? Let me know in the comments. Number 4. PepsiCo, ticker symbol PEP. This one is in my portfolio. It's a defensive beast, and finally at a price that makes sense. Pepsi is down about 12% year to date, and while its revenue is flat, it's a dividend machine. We are talking about 4.3 to 4.4% yield, which actually beats 10-year US Treasury bonds. It owns Lay's, Gatorade, Doritos, the works. So why is it cheap? Mainly due to Trump's tariff talk, potential SNAP restrictions on junk food, and the Make America Healthy Again initiative. Basically, the US is going after Pepsi's entire product lineup: sodas, chips, candies. But I think it's a temporary noise. Pepsi has a rock-solid distribution network, a reliable balance sheet, and a 50-year history of increasing dividends. For conservative, long-term investors, this is exactly the kind of buy low moment that pays off later. Next in the list is Novo Nordisk, ticker symbol NVO. Okay, now we are getting into some really exciting names. Novo Nordisk is a Danish pharma giant dominating the global insulin market with a 35% plus market share. But what's gotten everyone's attention? Their weight loss drugs like Ozempic and Wegovy. These things have gross margin over 80%, which is a software level insane. You make it for $200, sell it for $1,000, and demand off the charts. The stock recently dropped from $140 to $70, but the fundamentals are still elite. Strong pipeline, global leadership, high margins, buybacks, dividend, ongoing growth. I'm adding it to my portfolio. To me, this is the perfect combo of health trend tailwinds, pricing power, and long-term demand. Number 2 is Warner Bros. Discovery, ticker symbol WBT. Big moves are happening here. By mid-2026, the company plans to split into two: a streaming media gaming company and a legacy cable cash flow machine. This is huge. Why? Because the streaming business will now operate without the debt drag of cable. Cable stays with the debt and continues to generate steady, boring cash. Meanwhile, the new streaming division can grow and become more attractive to investors on its own. Clearer story, cleaner financials. I think this move unlocks value. And yes, I plan to add this to my portfolio too. What do you think about this kind of corporate split? Smart move or red flag? Let me know. And let's move to number 1 on this list, Thermo Fisher Scientific, ticker symbol TMO. Now, for my top pick, one of the best companies in the entire healthcare sector, hands down. Thermo Fisher doesn't make drugs. It sells the tools, services, and infrastructure needed to create the drugs. Think pipettes, spectrometers, lab equipment, clinical trial services. Basically, every time someone makes a new drug, Thermo makes money. It's like ASML in semiconductors, not the end product, but the enabler. The stock is down around 20% year to date due to US government cutting research grants, tariffs, tight university R&D budgets. That means a projected $500 million drop in revenue this year. But here is the thing, it's a short-term hit. Future PE is only 18 now, down from 30 plus. I am buying because this is a long-term compounding machine. Solid margins, diversified global revenue, great cash flow. This is the kind of stock I want to hold for 10 years. Which one of these stocks would you add to your portfolio right now? Do you agree with the thesis, or would you pick something totally different? Drop your thoughts below. I always read the comments. And at the end, here is the big idea I want to leave you with. Buying when stocks are down, not when they are hyped, is how long-term wealth is built. If you liked the video and would you like to support me, the link is in the video description. And if you are wondering how the world-famous Trump versus Musk Twitter war is unfolding, check out this video. See you there.